Hello, income harvesters and income investors. Welcome back to the channel. Today, we're going to talk about sector or industry ETFs. So, what are these? Basically, these are funds which are targeting a certain sector or industry, and this is useful if someone wants to target a certain sector or certain industry to invest in. It has its own risks and rewards and pros and cons. So in this video, we're going to talk about that, and so that you can get a full picture on how these work and how you can utilize that if you're planning to invest in these kind of funds. Okay, so let's get started. So all content here is for education purpose, not financial advice. So with that, let's get into the details. What is a sector ETF? So this is basically an ETF which invests in a certain sector or a basket of stocks in a certain sector. So that's simple. For example, there are funds which invest in IT sector, there are funds which invest in energy sector. So there's one example I've shown here, which is a S&P 500 fund which invests in the energy sector. It's the XLE or S&P 500 energy sector um ETF or this energy spider ETF, which is very popular. And this ETF invests in stocks as per the benchmark index. Like, for example, there are funds which follow a certain index. Um, so the second point is like there are funds which follow a certain index, that's why they are called passive funds because they passively follow that index. So if the index gives a certain formula or a mix of stocks, the fund is going to exactly replicate that index and mirror the stocks and mirror the performance of the index. So that's why these are called passive type funds, and the proportion and weights are similar to the index, like I mentioned. So these are fund. There are some active funds too, where the fund manager uses discretion to choose certain stocks. So that's another option that you can look at. But this is the starting point that if you understand this, that you are investing in that sector, not the entire market. So that's how these funds work. Okay, let's go to the next area. So who determines which stocks fall under that sector? Like how do they choose those stocks? So like I said in the previous one, like there are two types of funds. One is the active and the passive. We are going to discuss more about the passive funds in this video. Um, so in the active funds, the selection of stocks are at the fund manager's discretion. So they use their own judgment or research analysis and findings to choose stocks which will be part of the fund. And in the passive funds, um, the fund manager is going to just use the index as a reference and build the portfolio according to the index. So basically, they are going to just mirror or copy the index components and create a portfolio according to that. And here, one point to remember is these funds use the passive funds use the Global Industry Classification Standard (GICS). Basically, GICS is some kind of standard which defines what are the sectors, what are the industries. So the answer to the question is the GICS industry classification gives you the exact industry and sector, you know, um, definitions or classification, or how do you define the scope of what is a sector, what is an industry. So we will look into the details as in the next one, but here you get the idea that these funds use certain indexes. Like it's not a random selection, but it's based on the index that the fund selects those stocks. Okay, so I'm going to just dive a little deeper, not so deep, but briefly into how this works. Some of the large companies like Morgan Stanley Capital and S&P, State Street, and so many other fund companies, they use something called the Global Industry Classification Standard, and it is developed by these companies, Morgan Stanley Capital and S&P. And here, what they do is they first take the overall market, they define that into 11 sectors, break down the market, whole market, into 11 sectors. Um, there are so many sectors, but this is going to be very broadly into 11 sectors. For example, healthcare, financials, technology, like that. Like you define the broad sectors, and the broad sectors will cover various parts of the economy, and that forms a whole part of the S&P 500, for example. And these 11 sectors would represent the entire economy, and you can invest in ETFs or index funds which are representing that specific sectors. So out of the 11 sectors, you may choose some sectors or four sectors, depending on your need or depending on your requirement. And the sectors are further broken down into 25 industry groups. Okay, let me explain. For example, if there is a financial sector, uh, the financial sector will be broken down further into different industry groups. For example, you would have banks, you would have non-banking financial companies, you would have mortgage companies, and you will also have insurance companies. You would have other things like stock exchanges or other types of financial companies included in this um, financial sector. But there are multiple industries, like there could be regional banks, there could be, large banks, medium-sized banks. So, industry group is a subdivision of the sector, and within that there would be industries and there would be sub-industries. The exact classification you can find it on the website, so I'm not going too much into that. Um, you don't have to worry about exact details of how this is broken down. Just keep in mind that you can invest in broad sectors or you can invest in those industries. Like um, again, there is a different layers of classification, like industry groups, industries, sub-industries. You don't have to worry about that. It depends on the size of the industry, how it is classified. For example, in pharmacy, for healthcare industry, so in healthcare sector is a broad sector, and within that you might have like um, healthcare equipment and supplies. Then you might have pharmaceuticals, and then you might have something like healthcare facilities. So different types of you know breakdown of these sectors, which form different industries and sub-industries. That's how it works. Now, how do these, sector ETFs operate? Like, s- some of them have like sector-oriented funds, sector funds. Some of them have industry funds. Like industry could be industry, sub-industry, anything. I'm just using the general word industry to tell you that it could be either the sector or it could be the industry. And depending on how broad you want to go and how you know focused you want to be on certain industries, you have the choice. Like for example, in technology, you can get into information technology, product services and communication companies, and you can get into specific area like chip manufacturer or artificial intelligence service providers or any specific area of the ID industry, for example. So most funded funds have sector ETF products. That's pretty easier to understand because it's a much broader sector. And if you're starting out, it's better to go for the sector ones because it's more broader, more diversified. So you're not pigeonholed into one particular industry or pigeonholed into a very small sub industry. So you may want to choose the sector ETFs. The most popular ones are like um, iShares, State Street, Vanguard. There's so many Pro Shares. So these are the popular ones which have these products. You can go to the website and look, check out what works for you or what's suitable. And these are just for again illustration purposes, not specific fund recommendation or investment advice. No, this is just an example of different funds. You can go to various other funds like Fidelity or even Invesco if you want to go for a more broader, choices. Okay, so you have various funds to choose from. So you would not, have the problem of lesser number of funds. You'll have a problem of plenty of funds to choose from. And yeah, now when you have these plenty of funds, now why or what is the reason for looking at the sector ETFs? Like I already mentioned initially, it's about to benefit from a potential of a sector. That's number one. And secondly, you are trying to use past trends or patterns to you know find out what the opportunity is in the future. Like based on the past performance, you find that in the future the performance would be far better, or you see more opportunity in the future compared to the past. In an unfavorable sector or in a favorable sector, you see more growth opportunities. So in that you want to build a trading or investing position. So that's the second reason. And thirdly, the reason could be like you have an idea that you want to invest in a sector because you already have a stock portfolio which covers various sectors. Let's say you have not invested in let's say, new technology or cryptocurrency or the new sectors, or the new chip makers, etc. So you want to pick a basket of stocks which are part of the cryptocurrency industry because you find it too risky, or you're not able to pick a certain stock, or it's difficult for you to, uh, do research and pick stocks, right? So that's the reason you may want to pick a basket uh, in an area where you're not familiar. Or if someone is not familiar with the pharmaceutical industry, you don't know which pharma stock to pick, then you can invest in the entire pharma ETF. So that would give you the entire basket in one shot. Like just one ETF will give you the entire basket of the entire industry. So that's a great way to get a sectoral exposure, not a single stock exposure. And you save time and efforts on research, stock selection, and trying to see which company is good and looking at the financial statements, looking at the conference calls, the transcripts, looking at the latest developments and news in the company. It's a lot of work that you have to put in if you are going to choose certain stocks. But if you're going to choose the sectoral ETF, you still need to do research, but you don't have to go to every company and read every balance sheet and every, you know, quarterly update and conference call details and all that. You're going to save huge amount of time and effort on stock research and selection. And this is very important for people who are actually into full-time jobs or into professions, and you don't have the time to do that. Even myself personally, I like this advantage that sectoral ETFs provide me because I don't have the time or the bandwidth to do all the research, even though I may have the knowledge or the some experience in that, but the kind of bandwidth and effort required is pretty high. And mind you that you're also competing with some of the greatest brains in Wall Street and with the PhDs and all the Harvard and Ivy League degrees. So you are going to face tight kind of competition in the market. And if you can do well, that's great, but it's going to come with a high amount of cost and effort. So if you can save that effort, it saves you a lot of time, especially for investors. Um, with all this, what I would again say is like, the idea of picking a basket is very appealing. That actually explains everything to you. Like you benefit from the sector potential, and you also benefit from trends, and you also save time. The one biggest thing which I tell in every video, like you can watch my video, is the risk of single point of failure. So with when you're choosing a basket, any kind of basket, index ETF or even a sector ETF, sector ETFs are more risky than the index ETFs, but still, even though you have the sector or industry risk, which is prominent in sector ETFs, you still have diluted or curtailed your risk of single point of failure. One single stock is not going to damage your portfolio dramatically. So one single stock falling by 50% or going to zero is not going to completely make your ETF go bankrupt. Even if that happens, there are systems and processes in place uh, to stabilize the fund, and the fund will also update every 3 months or on a regular basis. They rebalance and they add a few stocks, they remove a few stocks. So some kind of cleansing mechanism happens in the ETFs, especially the index ETFs. So that's the reason I would recommend passive or index based ETFs, where this cleansing mechanism takes care of the risk. However, the risk is not going away, but it's kind of curtailed to a very large extent. So you are dealing with a smaller amount of risk. So you can focus more on the long-term investing plan. So that's the reason you want to invest in the sector ETFs. Okay, now let me give you a few other points that you need to consider or look at in terms of the sectoral or industrial industry focused ETFs, because it's not going to be straightforward, because unlike index ETFs which have a bit of every sector, it's automatically balanced, so you don't have to apply your brain or try to do something. But here, you are actually trying to um, manually pick certain sectors which will do well. So you're actually doing a little bit of timing, little bit of selection of industries. Even though you're not selecting individual stocks, you're still selecting individual sectors, industries. So you have to choose industries which are going to do well. and remove the industries which are not going to do well, or keep some of them for long term, that kind of thing. So in certain markets, certain conditions, some industries do well. In some economic cycles, some of them do well. So the next two pages are going to be about economic cycles, and some of you are familiar with this, so I'm just going to you know give you a quick summary and then explain how this works. For example, if the economy is in an expansion, like growing stage, you have certain industries which will benefit. For example, financials, tech, consumer discretionary. These are the industries which will benefit in the growing economy, right? Because when there is a growth in the economy, the banks and financial institutions, they lend more, they finance a lot of sectors, they make income from those loans. And similarly, consumer discretionary or consumer oriented companies benefit from that, because when consumers are able to purchase more or do more shopping or do take more services, so they benefit from that. The unfavorable ones are consumer staples, your bread and butter companies, grocery companies, etc., and healthcare and utilities. It's obvious. Healthcare and utilities are the ones which do well in a very recession oriented or a very slow economy. So you're already familiar with that. And utilities do well in a very slow or even a fast economy. But in an economy which is very growth oriented, utilities is not the favorite sector. So that's how it works in the expansion mode. Sometimes the economy slows down as well. So in the economy expanded, now it's slowing down. So what happens is the above factors actually kind of turn the opposite way. The consumer staples, healthcare, and utilities are going to be benefiting, and in the slowdown market. And some of the sectors like materials, consumer discretionary, real estate is going to get hit in the slowdown. Similarly, consumer discretionaries, people buying the home appliances, home improvement products, all that is going to go down, and people buying cars and all that is going to go down. Materials industry is also going to get hit because of the hit on the consumer discretionary. So this is pretty easier to understand, expansion and slowdown. But we are talking about a normal expansionary economy and a economy which is slightly slowing down. Slowdown is not a like a bad slowdown that I'm talking about here. This is a growing economy, but it's growing slow, or kind of the growth is slowing down. But the next two I'm going to show you is like a contracting economy and a different kind of a scenario, and recovering economy. So which happens after a kind of recession. So right now, if I look at it, like currently interest rates are getting cut and all that, we are in a kind of recovery stage, and soon, probably next year or 1 year later, we may be in the expansion stage. So these are just guidelines. You cannot easily predict exactly where we are, and the degree of impact of each sector in each cycle can be different. Sometimes financials may be strong in the expansion phase. Sometimes financial may be strong in the slowdown phase. It all depends on the specific companies and how they respond to these cycles. So let's look at the other side, recession and recovery. Okay. In the recessionary economy, you will have consumer staples, healthcare, and utilities, which are going to do well because everybody wants to take that safety net. They will move to these sectors. They will try to hide behind these sectors. But communication services, real estate, industrials, these are going to get hit. This is kind of similar to slowdown, but this is a kind of recession. So you will also have things like information technology getting hit because companies spending on IT and IT services are going to go down. Communication services can get hit. Some of the utilities like telecom can get hit because the economy is in a recession. People may stop spending on certain things. Consumer staple healthcare and the regular utilities like the gas, electric will do well. Now, what happens when the economy is recovering? Like it's gone to a recession and now it's recovering. Like it's gone to a certain bottom and now it's gradually getting into the green and recovering. So the sectors which will benefit would be consumer discretionary. Now people start buying, and probably they start renovating or building homes and all that. And the technology sector also starts recovering along with communication services. All these social media companies and all that, they start recovering because you see some growth in the mainstream industry, which also translate into growth in the communication services and tech industries. What would happen is like previously in the recession, all these healthcare and consumer staples were the darlings of the industry, right? Now these darlings and these favorite ones are going to turn unfavorable because now people see that economy recovering. Now they will not be interested in the healthcare or consumer staples. They will move into other areas. So people have this tendency to rotate into different sectors, whether it is the individual investors or institutional investors, all types of investors. At some point, people are going to rotate into new industries and new areas where they see a lot of opportunity, a lot of growth potential. So there, nobody is going to be, stuck to one place because they are a long-term investor. That's very good on the books, but in reality, people are going to change, and it's important to do a rebalancing and change once in a while to stay in tune with the times. Okay, with that, let's move to the next area. Um, Whatever I discussed in the previous two slides, this is just a quick summary of the same thing, but I just wanted to give you a different perspective. When you are looking at a certain industry or sector, or even an ETF, whether you want to invest long term, short term, like you need to remember these factors that affect a certain industry or a sector. I think some of you who have done, commerce or business or MBA or any kind of those degrees or economics, for example, you would have come across these concepts, and even people who have done marketing or sales would have heard about these things. See, these are basically the uh, industry specific competitive forces and things that will influence the industry's forces. um, Porter's five forces model is an example of that. You can do a reading on Porter's five forces in Google, or you can go to Wikipedia and read about it. Michael Porter is the inventor of those Porter's five forces model, and you can do further reading on that. But I'm just giving you a quick summary of what are the different areas we look at. One is what stage the industry is in, whether it is in a new industry or it's in a growth stage, or it is in a matured kind of industry, or it is a kind of declining industry. The industry is in a decline, or is the industry already becoming irrelevant? For example, once upon a time we had pagers. Today, when we look back, like we don't know what the pager is used for. Like at one point of time, it was an important industry, and we also had fixed line phones back in the 90s or even before that. Today, the importance of fixed line phones has reduced dramatically. It still exists, but it is reduced dramatically. So industry's life cycle or industry's cycle is important. That's number one. And the second is competitive forces or dynamics. Um, what are the different forces affecting the industry? Whether it is the new technology or new products or anything that is changing. Like it could be the way the industry functions, etc. Like for example, you have the social media or new trends coming up. So those are the new forces or dynamics of the industry, and how the competition is responding to that. That's also factors that come into play. The third one is regulatory environment. This is obvious. The law and regulations govern all the industries. Probably there are industries regulated by a certain body, or there are some licenses and permits to be obtained if you want to do business in that industry. So, or there are some regulations which allow some industries to, um, function in certain geographical areas, and some industries to work in other geographical areas, or there are restrictions on how many, you know, um, stores or how much of operations you can do in a certain period of time. So that's regulatory environment. Especially if you look at media, it's kind of regulated. Similarly, you have other regulated industries. Like, for example, you have even securities industry. The stock market is regulated by a certain regulator. Most of the industries have some kind of regulation, whether it is a small or big. The amount of regulation can vary. Some industries are highly regulated. Some of them are like partly regulated. Okay, then you have barriers to entry. Barriers to entry can be like how difficult it is for a new player to get into the industry. For example, it could be like capital intensive industries are difficult to get into, or sometimes you may need a lot of machinery or land, um, kind of capital, but this is a different type of capital. Like you need a lot of land, a lot of machinery, for example, to do uh, agriculture equipment, for example, or if you want to do something like an infrastructure, company, you need a huge amount of capital, huge amount of equipment, and so on. So those can be barriers to entry. Similarly, sometimes regulatory, like licenses and permits, can be expensive. You want to enter into the telecom sector, it will be very expensive because you need to. pay millions of dollars to get a license, and for the first few years you may not make any money at all. So that's kind of example of barriers to entry, and that could prevent new players from coming into that industry, and that can be a positive for existing players to increase their profit margins. Now, new models or sunrise sectors. For example, you had these AI companies, you have these chip companies which have now become very popular. At one point of time, they were a new sunrise sectors. So these are also new players who come into the market and they disrupt the other industries, or they come up with new business models and new growth areas. Um, a couple of decades ago, even the social media or even these um, online companies were pretty new. All the Yahoos and Amazons of the world were pretty new at one point of time. So those industries can completely change the face of that sector or industry. Today, when you talk about retail, online retail is becoming much bigger than the offline retail market. Like the shopping malls or even the high street markets are reducing, and you have more people going online. Although the offline is not going to vanish, but still people are changing in terms of the mode of purchase or how they do the shopping. And technological improvements are transformation. As I mentioned already, people moving online, and similarly companies automating their processes. Instead of making physical payments like checks or cash, people are now doing online and electronic payments. So there is a lot of transformation in the way people do business, the way people do the transactions. When I say people, it could be individuals or companies or even the small business setups. The technology is penetrating all these areas. It's not just the large Fortune 500 companies. It's also the small and medium businesses which are now upgrading to the new systems, new kind of accounting software, new kind of social media marketing, new kind of systems to sell their produce, and even people are moving into the new sectors. And the last one is substitute products and services. This is an interesting one. Like for example, there were pagers and there were some devices used to receive messages, right? Today that is all extinct because the mobile phone took over the entire thing. Like whether it is pagers or even fixed line phones, the mobile phone took care of all that. And even some people use phones even for their regular day-to-day work, and it has taken a small piece of the computer, personal computer, or even the laptop market. So that way the smartphones have actually taken a big share of the market. Similarly, digital cameras, which are still working and doing well, digital cameras market share has also been taken away by all these smartphones. And if you remember the olden days, if you had physical analog cameras and all that, and you were used to seeing people go to the shop to print their photographs and so on, that market has also become extinct. So companies like Kodak, they have moved to a different industry now. They are not into that same industry. They have now moved into a different area of the industry because of the substitution of products and substitute services that have come in. So hopefully this would have given you a great insight into what are the different factors to look at. So if you like what you're watching, please subscribe to the channel and share it with your friends and family. Okay, now moving on to the next one. There are three strategies I recommend. Like as we are going to the end of the presentation, like we are looking at some of the key learnings. How to apply this if you are an investor, long term or a medium term investor. So invest in a select sector for long term. Like now, for example, you can choose two or three sectors to begin with and invest for the long term if you are starting from zero, or if you already have any stocks in your portfolio. I'll tell you about that in the next points. But if you are starting fresh, you can invest in select sectors for long term. And every quarter you can rebalance. You can look at the portfolio, rebalance it, choose complementary sectors, like choose sectors which are like opposite or complementary. For example, you can choose technology, healthcare, or energy. Like I talked about the economic cycles, right? Depending on the economic cycles, choose different stocks that work in different economic cycles. That's what I'm trying to say, so that you will benefit from the change in the cycle. So you will have a portfolio which works in all the different cycles. Okay, so that's the first point. And invest tactically in the sector ETFs with growth potential, which means you are picking sectors which have a future growth potential. you pick the sectors or stocks where the bug is moving. Like you are not going to pick a winners of the last year or something like that. You are going to have to do some research to see where the things are moving and which are the sectors which will benefit in the next 2 years or 3 years. So that requires a bit of research and looking at reports and so on, but not that difficult. You can find that information. And also there's another alternative, like you can choose unfavorable sectors. This requires more experience. This is for more experienced and someone with a little higher risk taking ability. You can choose unfavorable risk sectors which have growth potential in future, or you can um, choose a safer sectors like utilities. That's unfavorable, but still it will work out well in the long term. So those are other ways of investing into contrarian type of investing, like you are choosing unfavorable sectors which is not popular. So that's about the tactical investing in sector ETFs. And third strategy would be like you can use it as an add-on. Like you have an existing portfolio, you already have some stocks, like 5 or 6 stocks or 10 stocks, whatever the number is. Now you can pick a sector which is not represented in your current portfolio. Like let's say your current portfolio does not have technology stocks. Now it's a great idea to add a technology sector ETF. Or if your portfolio does not have healthcare stocks, it's a good idea to now add healthcare ETF um, to complement your portfolio or make it more complete. So that way you can pick complementary ETF to complement your existing stock basket. And you can also do this as a way to bet on sectors which are uh, very promising, but you're not familiar with those stocks or companies. You know that these companies will do well, but you don't know how to pick those companies, or you're not able to do further research. For example, pharmaceuticals or even semiconductor industry, for example. So you know that this sector is doing well, there are good opportunities, but you're not familiar with those stocks. So you can take the whole sector ETF instead of picking the single stock. So that is a safer bet for you to take. So these are the strategies for an investor. The next, this is again illustrative, not do your own research on this. Okay, I'm not a financial advisor, so do your own research and due diligence. And next, I'm going to talk about a couple of strategies for a trader, like, or someone who is a very short-term oriented. Okay, if you're a trader, the first one is like a swing trading opportunity. Like you can look at sector ETFs too as a good swing trade opportunity. You can buy at a certain point of time, sell at a sell at a higher price at a different point of time. So it can be a good option for someone who is looking at few days to some weeks. You find one sector which is very unpopular, unfavorable, but you know that it is going to do well in the future. An unfavorable sector today, going to do well in the future. Buy now, accumulate a little bit. In the future, you have that wonderful swing profit opportunity, and you can make money on that. So that's the simple way to put it, but this requires a little bit of research on the technical side, technical analysis of the stock and the price levels, and what is the resistance support and all that. Plus, you may have to do a little bit of fundamental research to see which sectors are promising. The next one would be position trading. This is a kind of area which I'm also researching on. Um, I'm researching on both the swing and potential position trading, but um, these areas are pretty new for me as well. And I would say that when you're doing position trading, it's a little different from day trading and swing trading. People who are into the trading side, you are already familiar with how things work, and you have certain risk management system like a stop loss or certain triggers, or when to sell off a position, or how to book the losses, how to minimize your losses while maximizing or optimizing your gains. Now, if you're looking at 50 days or more, like, then swing trading may not be a good opportunity. You have to take it like a position trading, which means that you have to be prepared to hold it for a longer period of time, which means your capital is going to get locked for a longer time. So in this case, like it's not going to work like swing trade. You may have to hold on to a position for like a few months or even a year, for example. So this can be something attractive for someone who wants to make the long-term strategic bets. For example, you believe in the long-term potential of a certain sector. For example, You believe in the long-term potential of financials over the next 1 year. So when I say long-term potential, like the sector has to grow from today to next year to next year. You see that clear pattern, or you know that the downside risk is pretty less, but the upside is pretty clear in terms of the potential, and you know at what price or what levels you want to buy or accumulate, and you have done your technical analysis, support resistance, and you know the buying zones and where you want to enter. So that's the point you want to get into a position trade into a sector rather than choosing a stock. You're picking a sector because you know the sector is going to do well. For example, you identified a sector, for example, let's say cryptocurrency sector. This is going to do well. Instead of picking a certain company, you are picking the entire sector. So that way you're diversified, like, and you are not bound by the fundamental, volatility. Like because in some new sectors, it's not just the technical part that works for you. It's also the fundamentals that can go with you or against you sometimes. So yeah, you got to be careful in that. So in position trading, you have to use a mix of fundamental and technical analysis and take decisions. And sectoral ETF is a great way to do that instead of going through single stock trading, which you're already familiar. So so you can experiment with one of these strategies and see what works. Like, this is not a strong recommendation, and this is not a recommendation to change your style if you're already working on this. But you can use this as a small test case and see how it works. And then if it works for you, then you can use that as a part of your strategy. So again, this is all for illustrative purpose, not a recommendation. So I hope you liked what you're watching so far. And if you like the channel and if you like this content, feel free to subscribe and also follow my channel on YouTube and give that like. And thanks for watching. Have a great day. Happy investing.